Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. I'm going to talk a little bit about time frame. Time frame. So I know we've got a lot of new investors. They're or ones that just haven't really dug into, I guess, the markets or whatnot. And one of the most important things that I had to learn as I progressed as an investor is time frame. Time frame is your outlook or your paradigm of how fast things are supposed to happen. It's taking an outlook over a certain time frame. And younger investors or investors that are very impatient, they have very short time frames. What is a short time frame? What's a long time frame? What should be the time frame I should be looking at things? That is the ultimate question you should be asking. What is the time frame that I should be looking at my investments, and why? A lot of people look at the time frame of their investments in weeks, months, or maybe 1 year. It's too short. Too short of a time frame. And why is it too short? Because nothing happens in a year. I mean, yes, some things can happen dramatically in a year. I get it. But the cycle that drives everything, or I should say, one of a common cycle that drives everything. There's multiple cycles that overlap each other. Some are very long in nature, like big old credit cycles. There's the normal cycle that I'll call it that happens that I think everyone is very used to. It's like an 8, 9, 10 year up cycle, and then you get a down cycle. It's usually known as like 16 years, 18-year cycle of an up and down cycle of real estate. Some people call it the business cycle. That's really the time frame that I look at things. So when I look at things, I look at it from an 8 to 10 year time frame, or even longer. What Warren Buffett did, and some of these really good investors, Peter Lynch, Warren Buffett, they said, "Screw it, we're going to take a really long time frame." And they took time frames like massively, like a lifetime of a time frame. And they said, well, if I get in a company that sells something that doesn't really get phased out, this is the Buffett approach, kind of. He would take investments and look at these investments and say, what can I invest in for 50, 60, 70, 80 years? I mean, that's literally his time frame. And what he'll do is he'll say, this company's really undervalued. I like their product, and it's really hard to get into it. That's the moat. It's really hard to kind of get into this industry or this sector. So he puts a bunch of money in it. They're usually companies that I'm going to say are tied to food, beverages, insurance, things that people need, but they don't really, it doesn't really get phased out. It's a benefactor if technology increases because they become more efficient at delivering goods or services to their end customers. But whatever they're delivering doesn't go out of style. So it's food, beverages, candy, whatever it is, right? And all of these companies control the selling price. So they can ride through these ups and downs of these cycles. And if you take a big, really long-term approach, the demand for their products essentially goes up with the population growth around the world. And as more of the world adopts these things, it has more sales. So think of like Coca-Cola, and I know he's not in Pepsi, but it's the same thing. And people eating chips and whatever else there is. So, I mean, basically that's kind of his investment type thing. So, he doesn't have a week or 4 weeks or months time frame. That time frame doesn't match up or align very well with most of these really good investors over that take a much longer time frame. So as you shrink your time frame, the probability of success decreases. So day traders, they like get wiped out. It's like everybody gets wiped out who day trades. Like 99 point something percent lose all their money. It's something on the lines of that. A very high percentage of people who do very short-term trading get smoked. And as you lengthen your time frames out, a lot of people become a lot more successful. And in commodities, you're going to have a time frame that, in my opinion, has to be somewhere around 8 or 10 years or something like that. That is kind of the full cycle. So if you can wrap your head around the time frame and get that time frame right, what it does is it allows you to be patient if you get your time frame right for your investments to work. If you're trying to buy a bottom of something, then it's going to take time for it to turn around. It doesn't happen in weeks. I mean, 1 week is literally nothing in investing. It takes years. Peter Lynch says, you know what? You need at least a 2 or 3 year time frame for your investment to see if it actually works or doesn't work. He says a minimum of 2 or 3 years. And I think that's probably about the right time frame. If you're buying a bottom, it could stay down there for 6 months, year, 2 years. It could even cycle longer than that. I've been in platinum for a couple of years now. I started buying it in 2019. I was buying, I was getting my feet wet. I was getting some good buys in there. And we crashed in 2020 with the COVID crash. And I said, all right, I'll just buy more. I bought a whole bunch more at the bottom of 2020. And there's certain things that don't allow me to be scared. And it's knowing the cost curves. It's knowing the ratios. It's knowing information, saying that I'm buying this thing that's cheap. That's how I'm not being afraid. I'm buying it when it's cheap. And I continue to buy it because I see it as a store of value, and I see it as an undervalued asset class. So it's really that simple. It's not. So there's one thing I want to go over, that someone posed a question, and I want to tie it to time frame and understanding what you're buying, knowing the ratios, knowing the value, knowing where your cost curves are at. It depends what you're buying and all this stuff. So there's a couple of things I wanted to touch on with respect to this question. Let's read the question here. It says, so many people are screaming panic regarding an economic collapse to get money out of the market, but it looks so strong for commodities. Are they generalizing equity stocks and not distinguishing commodities? To me, I'm bullish on commodities. Can you help me calm the fear mongers about the impending economic collapse and who are advising to pull money out of the stock market? Yes, it can change, but if the dollar collapsed, we own shares or part of a company. Outside of monetary value, we actually own part of the company we have shares in. And I'm going to answer that, and this is going to be, it's kind of hard, and I'll be honest, as honest as I can be here. This is so in my opinion, I look at it from a couple of different perspectives. Number one is, a lot of these people are selling fear because fear sells. Because fear sells. So on YouTube, you get a positive feedback. You get a positive feedback loop. More views, more fear, more fear, more views. So they push a lot of fear on YouTube because they can get more views. More views equals more money and more revenue for that channel or whatever the heck they're selling. So that's number one, fear sells. Now, what a lot of people are doing is they're taking information from what they consider to be a bunch of different experts. And they try to make decisions based off of what they hear on YouTube or wherever else, articles on what experts are telling them. And I think what you need to do in order to become a very good investor is you need to bypass the experts and become the expert yourself. That's really what it takes. And I used to do the same thing as everyone else. I used to listen to all these quote experts. They would say all their different things. They would tell you certain things, and most of it did not come to fruition. Whether it be selling fear, whether it be selling why something is going to go up. It could be gold going to 5,000 that people were saying in 2009, or other things where or even better, in 2011 or 2012, go into 5,000. But I think what you have to do is you have to basically stop listening to a lot of those people. And I know you're listening to me right now, but in order to be successful, you have to figure out what the drivers are. So just like you would in manufacturing, I'm just going to give an example. There's certain things that you can monitor in a manufacturing facility to see if the health of the facility is either good or bad. One thing that you can do is you can walk throughout the floor and you just look at the standard work in progress. Basically, that's just saying how much WIP should be out there, how much partially built items should be on the line. And as you walk through it, you can verify roughly the pace, or if they're keeping pace by these work in progresses being pulled through the assembly line. Now, if you've got a bunch of holes in the line, you know that something's wrong. It could be part shortages. It could be a problem with a machine. Some sort of problem exists, and you can see it quite dramatically. WIP, the work in progress, is your leading indicator. All the other metrics behind it will play out, but you can see that first. One, you can see it on the line, and two, it's quite obvious. And it's one of the leading indicators that you can check. You're not going to be able to check it looking at a computer necessarily. I mean, maybe you could catch it by looking at transactions, or where WIP is piling up. But you just have to go out there and take a look. And in investing, it's the same way. You need to understand the drivers of what is driving what. What lags, what drives. And that's exactly what I did when I looked at the markets and created the thesis for the channel. I said, okay, what is driving things to change? What is driving asset prices to go up or down? And what drives stocks to go down? What drives commodities to go up? And what drives everything to go down? And that's really what I think you have to get and understand, is what drives it. Because if you don't know what drives it, then everyone who says something is going to scare you. So what I found ultimately is that inflation and interest rates, and I'm going to say inflation because inflation is what drives interest rates. Inflation is driven by the demographics of a population. That is what I found. And an increasing demographic coming into home buying years. So if you have a larger demographic, a larger population growth coming into home buying years, that expansion in the loans is what causes inflation in a fractional reserve lending system. It's an expansion of credit. That, in my opinion, is the driver. That inflation comes into the system and drives interest rates. If it's a smaller demographic, then it's the lack of inflation, which is a disinflationary environment if it's a slower growth rate. And if you've got a faster growth rate, especially one that hits like a wall, then you get a wall of inflation. Now, we've done some experiments with stimulus money, sending checks out, doing all this stuff. Obviously, I don't think we've done anything in the size that we've done it historically in terms of stimulus checks being sent directly to people. But there are some things that are also coming towards the end of a credit cycle that can also, and debt obligations and obligations with Medicare, Medicaid, and another demographic, a large demographic coming into, we'll call it the obligation age, where all these obligations that the government has is going to have to pay on them. So it's a combination of multiple things. It's a large demographic, the baby boomers coming into, we'll say, getting paid on those obligations. And then we have another demographic coming into home buying years, which is the millennials. And they're increasing some credit into the system as they're coming into home buying years. I think that's the driver. Now, maybe there's some people that can try to negate that, but I think it's pretty tough. You can look at Japan. They have a declining demographic. They've had a problem with their currency. It just keeps declining, just like their population. And that's kind of where I found the driver to be. Everything else is just a derivative of that, to some extent. To some extent, not all of it, but that's a large driver of it. That's the credit expansion and credit contraction. In the mid 1920s, we had a housing market crash in the late 1920s. So we had a big boom in the mid 20s, and then the crash at the end of the 20s, and then we had a big deflation afterwards. It basically screwed up the banking system, and we had, I'll just call it orgy loans, just like we did in the mid 2000s. It was the same setup. I don't think we have that same setup. I think we have a larger demographic. I think we've got a lot of 30-year fixed rate mortgages. I think it's a lot stronger market. But are interest rates too high? I don't know. We'll have to find out. But they've been increasing. And if you look at history and you kind of look at the crashes, usually what happens is the banks know when these loans will go bad. If they're going bad, they're going to see it. They're going to start piling into. They're going to pile into treasury bonds, and then the interest rates will come back down. So we'll see that positioning in bonds and the rates coming back down. Now, we can also gauge the I'll call it the robustness of the economy by what the Federal Reserve is doing as well. If they're increasing interest rates, they're worried about inflation. If they are holding, then we're coming to potentially a top. And if they're declining the interest rate, they probably see a problem in the market. Right now, they're increasing interest rates, and that's usually a sign that they're worried about inflation and not a deflationary or disinflationary type crash, like a deflationary crash, a deleveraging in the system. I don't think they think a deleveraging is coming in the system. So these people who are panicking about a crash, if it's a deflationary crash, I think they're wrong, and I think the Federal Reserve would also disagree with them. So that's my stance on that. And when interest rates are going up, that's usually an inflationary period, and it's usually a period where commodities do very well in. So what we should see, and what I do, is I try to align absolutely everything. I try to align what the Federal Reserve thinks. I try to align what interest rates are telling us. And then I align all of the chart patterns from a technical analysis base on commodities and stocks. Now, in an increasing interest rate environment, especially one that increases rates very quickly, we would see a large headwind in stocks. Stocks would definitely go down in that type of environment. And bonds obviously are going down because they're an inverse of what interest rates are. And interest rates are more or less a clearing mechanism in the bond market. As interest rates go up, it tries to attract more capital into the bond market. So interest rates attract more capital as capital leaves the bond market. So you have high selling pressure, increasing interest rates, and it tries to attract more capital into bonds as the interest rate goes up. And that is driven by a real negative rate. So you've got all this stuff. I know it sounds kind of complex or whatnot, but I think commodities are strong because of the environment that we're in. The market conditions is what I call it. It's a high level of inflation with a real negative rate. All that means is that inflation is higher than your interest rate. That means it's a real negative rate. And I'm taking the inflation rate, the consumer price index, and comparing it to the 10-year yield. That is negative. And when it's negative, people tend to be drawn towards commodities, precious metals and stuff like that. Precious metals, I would say, is more or less a factor of money coming into the system. Think of it as liquidity. Tightening cycle, gold doesn't like tightening. So when interest rates go up, especially very rapidly, what's happening is the real negative rate is becoming less, and liquidity in the market starts to slow down. And gold doesn't necessarily like that. But if the opposite is true, if we get a weaker dollar, gold's priced in dollars, and we have a declining yield, that is seen as monetary loosening. A real negative rate gets bigger. So that is some market conditions where, gold or precious metals do well under. So it's knowing the drivers, it's knowing kind of the cycle and what does well in that cycle, and having the right time frame of mind. I think if we look at the cycle here, I still think that we are not at the top yet. And usually when you get to the top of when you get to the top of the Federal Reserve's fund rate, it usually goes sideways for like a year. And then that is when I think we're kind of at the top. How much longer do we have with interest rates increasing? How much do we have where it goes sideways? That is still yet to be determined. Because I think we're coming into a period where it might be a little bit different than other periods. We do have a larger demographic coming into home buying years. The interest rates have slowed things down, but everyone's saying crash, crash, crash. No, we've got weakness in the market. Yes, there are some areas in America that are weakening, and we have some areas that are holding up very strong. Interest rates have slowed things down. Yes, I wouldn't have guessed that interest rates would have been this high. I would have said 4.5%, something like that on a mortgage rate. But we're over 7%. I know the pressure was there. You know what my problem was there? I let other people convince me that interest rates couldn't go that high. I knew the pressure was there, but I let other people convince me that they couldn't go as high as 7 or 8%. And I started to become a lot better when I just started blocking everyone else out. Doesn't matter what they think. Does not matter. I don't care if someone likes or dislikes a stock I own. I don't care. I don't care what one person says. I mean, is there validity in what they say? If there isn't, then why care about it? I think you got to get to the point where you just don't care what other people say, and you can basically stand on your own logic and reasoning and whatever thesis you've developed. And a lot of people are going to tell you you're wrong. I mean, that's just the way it is. And when you buy bottoms, that's how it feels. Everyone tells you you're wrong and you're doing something stupid and you shouldn't be buying whatever. So there is that type of thing there where they're going to tell you, you're wrong or whatever. And you don't need people to agree or disagree with you. It doesn't matter. You don't need people. So, I get a lot of people, they'll say this person disagrees with you. I don't care if they disagree with me. I'm comfortable in the data that I see and what I read. And a lot of these people, they don't know what the heck they're talking about. They're just putting it up, finger, let's do this. And then they see things in the short term. They don't know, they don't have their time frames right. They don't know what the underlying structural market conditions are. They don't know what the drivers of this are. They have no idea. The majority of these people have no idea what the structural drivers are. I mean, there's some that do, but a lot of them don't. I mean, if we go through an energy crisis where we're short energy, it's going to be inflationary, in my opinion. Why? Because everything is a derivative of energy. That is a leading factor. That is a driver. And we've been in a world where we've had a surplus of energy in the entire world. And if we don't have a surplus of energy, and I don't know, I'm speculating here on this, but if we get into a very physical, tight market of energy, this is it's going to be a very different world. Because the drivers, which is inflation, which is money, how much money's in the system in relationship to how much energy there is, that ratio, money to energy. And you can measure that through your M2 money supply in relationship to gross domestic product. If those things go out of balance, that's where your inflation comes from. Either, if you look backwards, your driver of inflation was what I described with the demographic coming into home buying years, and you get an expansion of the money supply. That was your variable in your equation. Looking on this going forward, that may be different variables in this equation. They may be changing. Maybe energy is going to be a larger factor and have to change the way that these economies work. I mean, really what they do is they just, the market, with higher inflation rates, the market, bondholders sell their bonds because they want a real return. And with a real negative rate, they don't get a real return. So they're always losing to the rate of inflation. Now, energy is the pacing factor of GDP. If we can't grow energy, we can't grow GDP. If we can't grow GDP and it actually starts to go down, that's called a stagflationary environment, where energy is a pacing factor of GDP, and then there's too much money in the system if GDP actually starts going down. So if you've got this wave of money coming into the system, which we have with the stimulus and all this other stuff, and your GDP can't grow, well, there's your inflation. So I think under those market conditions, what you'll see is you're going to see strong commodities, because that's where the tightness is. The physical tightness in the market is in commodities and energy. And I don't know how they're going to solve this, because we haven't seen a market, I think, so out of balance before on a global scale. That's really what's kind of scary. And you can verify what I'm saying by looking at the data of the charts. You can verify that with the 10-year yield breaking out of its 40-year disinflationary downtrend. You can see that breakout. You can see all of the bottoming patterns that we're putting in oil, in other commodities like rare earth metals, copper. It goes on and on and on. You can see these, and if you have a little bit of technical analysis, you kind of see all this. And maybe I can go over it. I know you're a platinum member on the website, but maybe I can go over that during our question and answer session. And what's going to happen is, other people don't know what we're describing here. They don't know this. They haven't looked at the data. They're just taking other people's experts' opinions and then trying to formulate their own opinion off of other people's opinions. And I'm sure you've played the phone game. You get a couple of opinions deep, and all of a sudden, the last opinion's nothing like the first one. So you have to really look at the data, and the data is, charts is a form of seeing data in a display, in a picture. That's how I like viewing my data for a lot of it. And then we can see the human psychology behind it as well. So I don't know. I'm not afraid, because I think I know where we are in the cycle. Obviously, no one knows 100% for sure. And all you have to do, or all you have to go on a lot of these things, are statistics and probabilities and what's cheap and what's not. And that's all you can do. But let's say you do have a collapse. All right, let's say we go down in something. If you have a long enough time frame and you ride through it, and most of these collapses are pretty short. When I rode through on some of my investments in 2008, I rode down the collapse and I bought a bunch at the bottom. I just kept buying and rode it all the way back up. And that collapse, I don't know, it lasted some years, but I mean, take a long enough approach, it really isn't a big deal. So the way that you can hedge yourself is by taking a longer time frame. If you take a short-term time frame and you try doing all these trading techniques, and I don't know, I've tried it before, I just don't think it works that great. The best thing, I think, at least for me and what I've done, is develop a method to figure out what is cheap. And then you take a very long time frame, 5-10 years, and you can buy the whole bottom of it. If you cost average in, which is another strategy, at least what I do, I cost average in the bottom, and then I ride it on up when it goes up. And then people say, how do you know it's going to go up? Well, because it doesn't just go down and go to zero. Nothing's gone down to zero if you're buying a commodity or something that's physical. Yeah, some of these companies can go to zero. I completely agree with that. But that's where your technical analysis and ratios and market conditions, they all tie together. You have to know when the money is going to flow into these things, that cycle. So I think being scared is a function of how well you understand the markets. That's what I think. If you understand them very well, I'm talking very well, then you gain the confidence to actually take entry points that are very low. And I think that's about the only way that you can basically be a great investor. You can't be a great investor by not knowing how to value assets, by not knowing what's cheap, by not knowing when to sell assets too. And if you look at the really rich, the really rich people, ones that have billions, they're very good at pricing assets. And they're very patient. They build things when they're out of favor. And when they become in favor, they sell things. So they have a longer term time frame, and they have a vision, and they know how to value assets and price assets. And I don't think a lot of these people that are on YouTube know how to do that. I think they're more or less confused. Yeah, there's a bunch of people reading charts, and charts are not, they're one thing. They're just one thing. It's not the big picture view. It's a way that I validate what I think is right. It's not a way to choose what companies, I mean, I do base fractals, some things that I do to choose companies. I will say that, yes, I do use that. But it's not the only thing. And I take an array of different data to make sure that it's all progressing the way I want it to. But no one's going to be immune. You could get caught in a sell-off. No one's immune to it. But knowing what I know and kind of what I've seen, at least last bull market, and what I've looked at in history, I'm going to remain on the long side because I think that the problems are in energy and commodities. And I think that's what's causing all of these people to think that the market is going to crash. If we had a lot more energy and a lot more commodities and inventories weren't so low, I think that we would have an initial surge in inflation because they did all this stimulus and we had a lot of homes being transacted and housing starts were up. And then we would see it kind of slow down. We could also see even more inflation if they could build homes faster. That's another thing that could happen. But I mean, I think it just comes down to what you know and how comfortable you are with the experience and what you know about the markets. It's about being educated on the markets and how to price assets. Because if you know that something's very cheap and the timing's coming, that's when you get aggressive. Otherwise, it's just dumb luck after that. It really is. So again, guys, I mean, if you guys like this conversation, I'm just trying to help whoever out. And you can obviously join the finding-value.com. I teach a lot of this stuff. I can show you on charts. I can answer questions directly. We can go back and forth during some of these question and answer sessions. I will be doing a training at some point on my strategies to go over very much similar stuff to what you're asking. And you can see it yourself and make your own opinions. But that's all I've got, guys. Give me a thumb up for the content. Subscribe to the channel if you haven't already. And we'll catch you guys next time. This is Finding Value.